All right, welcome to the Finspire's Focus on the Market series, our first quarter 2026 edition. As you can see, we're doing a few things a little bit differently today. We always tackle what's going on in the economy and the markets, and happy today to elevate the conversation today, as we've brought in some big guns here. Brian Levitt, Chief Global Market Strategist at Invesco, is with us today. He'll help us examine all the macro trends in the economy, but also what's going on in the markets. And also, more importantly, what's happening in your portfolio for 2026 and how to potentially reposition. So before we get started, I just want to read Brian's lengthy and impressive bio. Yeah, it's going to happen. Yep, it's going to happen. He's the Chief Global Market Strategist, Head of Strategy and Insights at Invesco, leads a team of market strategists, investment strategists, research professionals, who provide timely and compelling insights for all their clients from North America, Europe, Middle East, and Africa, and Asia Pacific. It's great to have him here. But let's get to the really good stuff. If you think you've seen Brian before, it's because you've probably seen Brian before. And so you might catch him contributing to CNBC, Bloomberg, Yahoo Finance, and whatever your other preferred financial news network is these days. More importantly here, Jacob, he has BA in economics from the University of Michigan. So Asher's money is going well spent to the University of Michigan. He too can turn out just like Brian, and has his MBA in finance and international business from Fordham University. So thanks, Brian, for being here.
Yeah,
appreciate to have your insights. We're looking forward to it. All right, you ready to jump in?
Yeah, let's do it.
Okay, so Brian's team puts together this portfolio playbook, and we're going to highlight a few areas of his presentation and follow a very similar pattern that we usually follow in the Focus on the Market series. So Brian, let's first put a bow on 2025. There we go. How do we get here? So 2025, third straight year, Brian, of double-digit gains on the S&P 500. Pretty impressive run that we've been on since the inflation interest rate shocks of 2022. What stood out to you the most in 2025 before we take a look forward into 2026?
Yeah, we started in the beginning of the year is what I would categorize as a Goldilocks type of environment. And I know my compliance department gets a little upset when I use Goldilocks, right? Maybe it's too promissory, but I said, if you don't let me say Goldilocks, I'm going to say Platinum Locks. They said, okay, say Goldilocks. So Goldilocks type of an environment, meaning growth was good, inflation was stable, but somewhat elevated, which is fine. That's good for corporate profitability. The Fed wanted to lower interest rates. Mm-hmm. So if you don't like that, I don't know what to tell you. And then, usually when you're in those types of environments, the rule is do no harm, right? And the incoming administration wanted to proceed in what was a strong economic backdrop to reorient the economy around tariffs. And you get this big downturn early in the year. People always ask me, when do market downturns occur? Like, when are they going to happen? They're almost always the result of policy uncertainty. And so once you got into this environment, tariffs on Mexico and Canada, and then Liberation Day, that's a lot of policy uncertainty. Where ultimately are we going to go with tariff rates? More importantly, we said the Fed wants to cut interest rates. Can they still do that if inflation is going to come as a result of tariffs? And so by April 8th, we desperately needed some policy clarity. April 9th became the third best day in the market in the last 30 years. Really terrible if you miss those days. Mm-hmm. And then a lot of the rest of the year was just incrementally moving towards better policy clarity, better understanding of where tariffs were going to be, better understanding of where the Fed was going to be, all the while a U.S. consumer that continued to do just fine, not everyone, but in aggregate, and businesses that were investing very aggressively in artificial intelligence. So in aggregate, a good macro year. Another very strong year for markets, but with Fed cutting rates, with the economy doing well on the back of the consumer, it broadened out. It wasn't just the same 7 stocks. In fact, 5 out of the 7 magnificent 7 companies actually underperformed the market last year.
Yeah, and it's not just in the U.S. market, right? Opportunities elsewhere. We'll get to that a little bit later on. Yep. But it was quite a year in the equity markets looking backwards. But let's take a look at the backdrop going into 2026. Mm-hmm. And let's take a look at growth. So it seems that the economy is reaccelerating,
Yeah.
right? And we had, despite the delay in government data due to the shutdown in the fourth quarter, that the third quarter GDP came in over 4%. Estimates are showing it for fourth quarter to be maybe 5% plus. We'll see. But what are you seeing with this backdrop of an economic growth, which seems to be accelerating going into 2026?
Yeah, and then these are forecasts here. And so what I always tell people is that the markets don't trade on good or bad. They trade on whether things are going to be better or worse relative to expectations. Far more often than not, things get better. You have these periods where your expectations for growth collapse as a result of some type of policy. What's happening now is you have forecasts for the year that are calling basically trend growth in the United States, or this move back towards 2%, where in actuality the economy is performing better than that. And leading indicators of the US economy are suggesting better than a trend growth rate. So if you think of it from the perspective of better or worse relative to expectations, the US economy is already performing better than what the 2026 forecasts were. And why do you get widening of markets? Because when an economy is performing better than expectations, that's when things tend to broaden out. Because if you are going to only do, call it 2% growth, you probably just bid up a bunch of growth stocks because there's just not enough activity for everyone. If you're coming in better than trend, that's when you start to see more small and mid and value and old economy parts of the market perform well. And that's precisely what January, really the second half of last year, and what January has been about. We all lowered our expectations so much because of tariffs that the economy continues to exceed that.
Surprise to the upside, right? So I thought this was really interesting. Now, there's a lot going on in this chart, but this requires your professional explanation here. But I thought it was interesting because as you pointed out, going from 2% growth maybe to 4 or 5% growth, you enter this area of expansion. But it's interesting. Give us some thoughts about where you think we are on this business cycle, if you will, or if we're in economic cycle. But then what I also thought was interesting is that you can actually move back and forth in this chart based on the whether it's the policy environment or what have you. So why don't you get into a little bit about where we are now and where we could go?
I always tell people first thing is think about the business cycle. Business cycles can last a really long time. So, this definitely is not early cycle, right? That was when we came out of COVID. Is it middle? Is it mid-late? Perhaps. It's not late cycle. We could talk about what late cycle looks like. But even in cycles, you go through these different phases. So there's times, even think about the last 5 years, you contract with COVID, you recover from COVID fairly quickly. Recovery just means you're below trend and you're coming up. Okay. Expansion is when you're accelerating above trend. Slowdown happened in 22 with the Fed raising rates. And then for the last, couple of years, Liberation Days and others, expectations, leading indicators have just kind of been, we saw that just kind of flat or towards below trend. So when you're in a contraction type of environment, that doesn't have to mean recession. It just means a below trend growth environment. And the prior slide, I think, showed that pretty well, expectations for below trend. So you want the Fed to be easing there. And you're there about 15% of the time. Note when you're in these other three, we stack rank these. Equities do very well in recovery, expansion, and slowdown. And those happen 85% of the time. So people are so negative. 85% of the time you're in recovery, expansion, slowdown. And by the way, even in that contraction, the equity markets did well. It was just a handful of companies that led it, right? Because it's more of a mega cap growth environment. No surprise, government bond yields came down pretty significantly, 480 to under 4. I loved it at 480 when, my colleagues overseas had to say, oh, finally, the U.S. can't fund its debt. Get out of here, right? Rates come right back down with slower growth. So what do we mean by a recovery? A recovery just means things are starting to gather some momentum again. You saw expectations moving up. In fact, the U.S. economy doing better than trend now. If you think about it globally, China's stimulating their economy. Japan's going to do more fiscal stimulus. Europe has already lowered interest rates and needs to spend money on defense. And the US has the One Big Beautiful Bill Act plus lower interest rates. So all of that gets the economy going again. The global economy can start to move back towards trend. We categorize that as a recovery phase. Generally, the Fed is still easy in that environment, which is why this market is not overly perturbed about the independence of the Fed, even though cocktail party participants seem to be perturbed about it. And in that environment, credit and equities do well. Equities usually broaden out where cyclicals beat defensive, small caps can do well, value can do well, emerging markets can do well. And the reason emerging markets do well is largely because the Fed's easing, so they can ease also. Yeah. And so this is a sea change from where we were in 03 and 04. Okay, and it's largely because the world recognizes, or the biggest economic blocs in the world recognize the need for more policy support at this point in the cycle.
Yeah, speaking of the economy itself, it's funny how catchphrases really do catch on quickly in the financial media, right? And so we're hearing more about this concept of the K-shaped economy, right? That yes, we're expanding, but yet it seems like people are a little bit grumpy out there, right? And so explain this K-shaped economy concept and really what the ramifications are from an economic perspective.
Yeah, my colleague drew this. I was really proud of him. So on the left is S&P 500 in the blue line, and then the orange is consumer sentiment. And it's just an interesting way to think about K-shape. So asset holders feel quite good. In fact, household net worth in this country has never been higher. It's over $170 trillion with a T. So if anybody's worried, or any of your friends or colleagues or clients are worried about $40 trillion in debt, just remind them that household net worth is $170 trillion. Consumer sentiment, though, has been quite weak. You might ask why consumer sentiment is weak at a time when household net worth's at an all-time high and the unemployment rate's still below 5%. And that's mostly because of the price of things. Notice I didn't say inflation because the inflation rate is different than the price level, but the price of things is still quite high and people feel like they're struggling to get ahead. Now, if you're to look at this by income quintiles, obviously your asset holders tend to be more at the upper end, are feeling quite good and are driving a lot of this economy. It's the lower income quintile that's really been hit hard by the higher prices and is really weighing on sentiment. And so the way I've often thought about it when people talk K-shape, and it may sound like I'm not empathetic, but I am. I'm just thinking about it from a macro perspective. If the lowest income quintile is challenged, that could be a slowdown in economic activity. When it's the upper one or two income quintiles that are challenged, that's more of a recession. Right, so that's where we're sitting with right now, where wealthy are feeling wealthy. And 2025 was really an everything bull market, where sentiment's weak. And you're seeing it, people are starting to get more concerned about the job market. So the job openings are slowing. There's a relatively high youth unemployment rate in this country. That's probably because businesses are trying to figure out what they're doing with AI, and they don't want to hire as rapidly a younger cohort. So job openings coming down while the S&P 500 is going up. So it's bifurcated. Now, again, challenges at the lower end is unlikely to end the cycle. It also, when you see job openings go down like that, likely means Federal Reserve's going to be lowering interest rates. I'm not sure that magically improves the job market, but they do have a mandate of full employment, so are likely to continue to lower rates, which probably helps that part of the K pretty significantly.
Well, you led us right to the next item, which we had for you, which was, yes, the Federal Reserve seems to be shifting a little bit more towards the labor market, maybe a little bit less towards inflation in their policy-making decisions. But yeah, you mentioned it. One of your items in your portfolio playbook was how to diversify yourself on a portfolio basis from AI, right? Yeah. Given that theme. So we're seeing it in the labor market too, whereas there's some consternation both at the employer level, but also could factor into that sentiment level that has been in decline.
Yeah, this is the 3-month moving average of job growth. So, when remember everyone was gonna retire, the Great Resignation, right? That was such nonsense. We hired a whole bunch of people, and then over time this has come down. And as job openings come down, as job growth slows, that's when that's when you tend to want to start easing policy, particularly if the unemployment rate's going up. The reality is, in this instance, the unemployment rate has not gone up rapidly because less supply of labor as well. So people retiring, less immigrants into the country. So you have not seen a big shock to the unemployment rate, but certainly job growth has slowed pretty significantly. Businesses are hanging on to people, though. Now, if you ask people, this is really interesting. If you ask people, is the unemployment rate going to rise? The answer to that is close to 70%, almost as high as you got during COVID, no, higher than you got during COVID,
Right.
almost as high as you got during the global financial crisis, which is really interesting. That all goes back to that consumer sentiment idea where people are doing well, they just don't feel like they're doing well. And people are really worried about what artificial intelligence could mean for their jobs, or what this next cycle could mean for the unemployment rate. So the expectation is pretty dire predictions about the unemployment rate. Although as we talked about, an economy that's likely to come in above trend. So I look at this again. The Fed says, I think Jay Powell said yesterday, we feel like we have our two mandates pretty much in balance. Do you? Like I would be lowering interest rates, and so every month when Powell speaks, they ask me to record a 60-second selfie video for LinkedIn. And so I work pretty close to the New York Fed, so I did this thing where I was knocking on the door of the New York Fed to tell them to lower interest rates. Nobody answered the door. So, but I look at it, and
Not even President Trump was there to answer that door.
nobody,
No?
and I wasn't one of his top 10. I'm not going to get the final rose. So the 10 years at 4.25. Usually you have 125 basis point spread between the funds rate and the 10-year. For me, that gives us room for a 3% interest rate, so long as inflation expectations remain contained, which is the big challenge. So far, so good.
Yeah, and that sort of leads us right into the backdrop that we started talking about at the onset, which was, yes, you have above trend growth, and you have a Fed cutting rates, which is a really solid backdrop for, not only to avoid a recession, but should be pretty good for the equity markets.
This has been my North Star now for a while, which is, if you break, sometimes the Fed is lowering rates because they're just late, and you've entered a recession, or you're about to, and if you've entered recession and they're late, look out below, right? That's that. These colors changed on me, and I was telling Lisa before, I'm a little colorblind, but that, I don't know why the green aligns with the purple, but whatever happened there.
Yeah. Yeah. Colorblind too. Yeah. So
I was
imagine two guys evaluating economic charts with no color, with no ability to see the colors.
I think, I was telling you, a lot of men are colorblind.
Yeah.
Now this line, whatever the heck this is, this is your period after your first rate cut. Markets tend to do incredibly well. This time has been no different. And periods that align with it, years like 1984, 1985, those are your, mid-cycle rate cuts when you get some type of slowdown, mid-cycle rate cuts, and then the markets tend to do quite well after that. So we've been very much of that camp, that it's not an economy entering a recession. We could talk about why I think that, or how we know, not the least of which is corporate borrowing costs keep going down. That's not what happens in a recession.
Right.
And if you're not entering a recession and the Fed's lowering rates, that's running things pretty hot. And you don't always get that, but when you do, you want to make hay when the sun shines. And so far, we've had 20-something percent, 20-something percent 17%,
Yeah.
right? And so that's the idea of making hay when the sun shines. Now, people can't leave well enough alone. As soon as it happens, it has to be an AI bubble, right?
Right.
Which or it could just be a mid-cycle easing environment, which is creating a nice backdrop for markets.
But that's interesting because you have this accelerating economy, and the previous chart was just on the S&P 500 as an index,
Yes.
right? And so now you're getting into, now we're getting into the portfolio level maneuvers from just being, say, invested in the S&P 500 index, right? So it's creating a very good environment for active management, but it also is shifting things towards a value-oriented potential. What are your thoughts there?
Okay, so this is a scatter plot. You take the 9 style boxes that Morningstar had created, and you look at the correlation of the performance of those style boxes to growth and inflation. So nominal growth in aggregate, but growth is on your y-axis and inflation is on your x-axis. And so when you look at the large growth phenomenon of the last few years, large growth doesn't need a lot of nominal growth to do well. It's down here in this. You don't need a lot of inflation. You don't need a lot of economic activity. I think intuitively, most people recognize that, but this is just a way to represent it. As inflation tends to go up, as growth tends to go up, that's when you start to see size and value perform better. So what you would need, people for years have said, well, markets are trading at better valuations in mid, they're trading at better valuations in value, obviously, outside the United States. Just because something's cheap doesn't mean it doesn't stay cheap. You need a catalyst for improved, to unlock value. And what we've had now, given better than expected economic growth, lower interest rates, fiscal policy in the major economies of the world, is a better growth backdrop. And if the Fed's going to lower rates in a good economy and Rick Reeder or whoever the next Fed chair is wants to let this thing run a little hot, then you would think performance would shift out more to the other style boxes. And what makes it nice for investors is because with all the talk of AI bubble, what I heard from people was, I have a lot of FOMO, right? I can't miss this market, but I'm nervous about it. And you could say you can build a better value portfolio, but in some years those better value portfolios will post a positive return, but they're not going to keep up, right? And you're still going to feel FOMO compared to your neighbor. But in an environment where things are getting better, or growth prospects are picking up, or inflation's moving a bit higher, well, then you have an opportunity for better value portfolios to outperform. And that's been happening really over the last 7 months or so. And even if you think of January, this month, if you think of people were worried about, how many things were we worried about in 29 calendar days? Venezuela, let you tell me what Iran, Greenland, European tariffs. I don't know, did I miss anything? Chicago Bears. Sorry, too soon. So
Trump suing Jay Powell. That was a good one.
Jay Powell.
Yeah, that was a big one.
DOJ, right? So, is the Supreme Court going to rule on tariffs, right?
Right.
And transportation stocks were just ripping.
Right.
Why? Because activity's picking up.
Yeah.
And inflation up, you charge a little more for transportation.
Yeah.
Right.
Turns into a lot of noise, right? Speaking of something that's been pretty noisy, and you've brought it up a couple times here, is look, we've got improved growth. We have yes, we have deficits. You've recognized that and talked about that, but so does everybody else. And but yet the dollar came off its peak last year, and you think it might still be overvalued.
Yeah, and so this is the pink here. This is all your dollar years. Okay, another great chart by a colleague of mine. These are all your dollar years, and then color-coded are the years in which the dollar goes down. So far more often than not, we've been living in a dollar, most years the dollar advances, even though I'm constantly asked if the US dollar is losing its status as the world's reserve currency and if investors should move all their money into the Brazilian real, and the answer is no. Or into Bitcoin, right? So this was this year. Now, why was the dollar so strong? Just think about it from the perspective of money's going to go to where things look best, right? And in '08, we had a financial crisis. It was epicentered in the United States. You would think that would be dollar negative. No, because the US responded more forcefully than the rest of the world did. 2020, pandemic, US responded more forcefully than the rest of the world did. So for a very long period, we've been in a strong dollar environment, given the amount of support the economy provided, the politicians provided, and some very impressive technology companies. Now, something's happening that many Americans don't remember or never lived through, which is a prolonged easing cycle in the US, right? Because in '08, you lowered rates to zero. In 2020, you lowered rates to zero. This is a prolonged easing cycle. And if you look, Europe's already lowered rates. China's already working to stimulate their economy. So wait, this is the first time that the US is slow to respond to a slowdown compared to the rest of the world. And our interest rates need to come down to the rest of the world. And so as that's happening, the dollar becomes a little bit less enticing. You add on to that the geopolitical volatility that's taking place, and investors start to diversify some of their currency exposure. Doesn't mean the dollar's collapsing. If anything, the dollar fell 10% last year and then sort of flatlined.
Right.
And now it's been creeping lower again this year. And so, when we say to people, you may want to diversify some of your dollar exposure, whether generate equity returns in non-dollar or generate fixed income coupons in non-dollar, a lot of that has to do with the fact that the currency, if we're right, will be additive to what you're generating. And we haven't seen that in a long time. And let's go back.
Yep.
If you look at the trade-weighted value of the dollar, so it's just the real value of the dollar versus a trade-weighted basket of currencies, all this is an index level, So it just shows you the direction of it. And that's your 10% decline.
Right.
So if you look at it, if you think of the average and then a standard deviation from the average, you're still somewhat elevated. Now, just because something's expensive doesn't mean it doesn't stay expensive either, but a lower interest rate environment with some geopolitical volatility means some diversification of the dollar may be warranted. You're seeing the central bankers do it, and you've seen what gold prices have done. And we think it behooves investors to think about non-dollar exposure in their portfolios. Not 100, most people are probably close to zero. So, raising that up to a more normal level. Now, we went back and we looked 50 years at the average returns when the dollar, on a quarterly basis, when dollar's down versus when the dollar is up. If you look, the blue, or whatever color that is, most markets tend to do well when the dollar's down. Dollar up tends to mean, some flight to quality or something like that. S&P does fine. People say, why would I own non-dollar assets? The S&P 500 companies are multinational businesses. Yeah, we're just thinking about this from a relative perspective. Right. The S&P 500 does fine. What you find is emerging markets tend to be the best performers, and lo and behold, what's been among the best performers recently, and IFA does well. And so there's this great debate of whether this is sustainable. The reason I showed the prior slide is just to say, look how elevated it still is. Even if it were to get to parity, that could still be quite a move. Or even if it got down to one standard deviation, right, it would be quite a move. So why does this happen? Emerging market central banks tend to have dollar exposure, and they tend to not be able to ease if we're in a strong dollar environment. Weaker dollar environment, Fed lowering rates, EM can lower rates as well, and it tends to help. Those economies tend to be cyclical.
Yeah, so that a good year again to be diversified. So you put together these investment themes for 2026, Brian. Why don't you walk us through the four main themes here and portfolio implications of each.
Yeah. I keep telling them to move two above one. And we talked about these. Easing cycle without a recession favors stocks, right? We saw that chart. And if you look at three, we showed, that reacceleration, whether it's in growth or inflation, tends to broaden things out, helps you to diversify your AI concentration risk. Right now, does that mean with Microsoft down 11% today, I don't ever want to own Microsoft? No, that's not what I mean by that. But what I mean is there's opportunities to participate in markets now in a way that didn't exist in a year like 2024. And then weaker dollar supports U.S. assets. So, these are the points that we write these outlooks in October, and you hope the world doesn't meaningfully change. 1 month of a year does not make a year, but promising we see a month in which small and mid does very well, emerging markets does very well. The S&P 500 doesn't keep up, but performs just fine.
I think we'll leave it at that. Brian Levitt, thank you so
you.
much for your insights. Fantastic.
Thanks.
Always invaluable. For those of you watching, thank you for joining us for a few minutes out of your day to check in with us, and not just with the Finspire team, but also with our special guest here, Brian Levitt. If anything you heard today, comments, questions, you want to feel free to reach out to your financial professional here at Finspire, and we stand ready to help. Thanks again for watching, and we'll talk to you real soon.